Welcome to Behind the Data. I'm Jeff Krimmel, founder of Krimmel Strategy Group. Each week, I take you behind the energy market analysis I'm publishing online. What surprised me, what I left out, and what I'm still thinking about. Let's get into it. The first post this week that seemed to get a lot of reaction was why energy executives are uneasy despite $100 oil and rising profits. The Iran war creates obvious tension here that's difficult for any executive. You have booming oil prices, and if you're an oil producer, that means tailwinds for your revenue stream. It means expanded profitability. These are all things that are helpful when you're running your business. One challenge, there's obviously the PR challenge is kind of a natural part of what happens with war. But when I talk to oil executives, they're anxious, but it has nothing to do with the PR side, right? No one brings that up. I think everyone's clear that making more profits during war can be problematic if you lean into that as a narrative. That's not in anyone's control at the executive level, and it's really not what's creating the tension, right? I mean, the tension is that the capital allocation calculus as an oil producer becomes more difficult when you have these much higher oil prices. There's a natural incentive to want to invest back into your business. Right to this point, it was relatively easy to just try to generate as much cash as you reasonably can. Oil prices continued to grind downward year after year, coming out of the post-pandemic high. But you just try to generate as much cash as you reasonably can, and then you hand as much back to shareholders as you can in the form of ordinary dividends or special dividends or your share repurchase, your buyback program. And so that was the name of the game. Try to squeeze as much cash as you can out of the business, invest minimally back in the business to sustain your existing production levels, your existing trajectory, and hand the excess back to shareholders. That's not terribly difficult to do when oil prices are suppressed. There's not a huge incentive to invest back into your business to try to grow production when the world is awash in oil and oil prices are relatively low. That tension becomes much more real as oil prices rise. And for at least the near term, there's a critical element of scarcity in oil supply with all the supply that's come offline as a result of the war in Iran. And so that capital allocation calculus becomes a lot tougher, right? Should we take these incremental profit dollars that we don't know how long they'll be available to us? Is this our opportunity to now invest that back into the business and to try to capture some sort of growth? And the tension there is real because investors, you've made a promise to investors that you're going to generate as much cash as possible and hand over the excess to them. So presumably they're going to be looking for excess returns here. They're going to be looking for special dividend allocations, right? I'm not sure that any executive team would actually name it, a war-driven special dividend program, but they would probably talk about, a geopolitical disruption dividend or something, and that's probably what investors are expecting. But oil executives have to think through, right? Is this the opportunity to capture some more profit dollars and to improve your business in ways that maybe you otherwise wouldn't if oil prices were quite a bit lower than they are right now. And so that capital allocation calculus becomes a lot tougher. And no one likes to solve tougher problems if you don't get any more credit than if you were solving easier problems, right? So no one's going to complain about having more profitability, all else being equal, right? When you have a war like this, the extenuating circumstances are truly tragic. And so there's a lot more sort of emotional weight to what's happening out there and what our obligations are when we're running these businesses. So that part's quite a bit more complex. But you still have more profit dollars than you otherwise would have had. And you have to come up with a plan about what you're going to do there. And yes, you can, shovel those over to shareholders very aggressively. And I doubt any of them complain about it. But there are other stakeholders in your business, and this is your opportunity where you might be able to address some issues that would be much more challenging to address when oil prices are lower. So that part is difficult. And then, as I wrote about in the post, right, there's other concerns that as oil prices stay high, you get to demand destruction. You get to some net oil consuming countries thinking about how to pivot their energy mix so they're not as exposed to oil shocks going forward. So there's some long-term threats to your trajectory that emerge when oil prices are at these levels and remain at these levels. And so that was kind of the context and the motivating element of writing this post, is that it is clear that energy executives are uneasy about today's price levels. And I wanted to offer a little color, nuance, perspective around what that conflict and that tension, that unease, that anxiety, if that's the right word, what the source of a lot of that is. And of course, the war proper brings a lot of that, but there's more complexity, in terms of second order effects that unfold from that. So my short LinkedIn post that got a fair bit of reaction was trying to unpack a little of the tension and conflict that existed there. Another post that I wrote about that was related to that this week was about the Brent-WTI surge, the surge and the spread between those two benchmarks. And I subtitled that "How Infrastructure Risk Drives Price Discovery." When I wrote that post, the Brent-WTI spread was at $9. And as I record this podcast, that spread's at $14. So even higher than when I wrote the post. And I wrote the post because, less than 2 weeks before the spread really blew out, WTI and Brent were at parity. So they were at parity, and in fact, I think WTI pulled just a little bit ahead of Brent. And then you get to a point where Brent now is $14 per barrel more expensive than WTI. So it's a bit of whiplash. And, for people that don't follow commodity markets closely and don't trade them and just aren't deeply involved, that whiplash can almost seem irrational. And that's not wrong, right? There's an element of these commodity markets that human psychology is profoundly embedded in these markets. And so we can see trades that happen in relatively short order that clearly aren't deeply deliberated, right? I mean, they're happening in the moment as news is breaking. Traders are trying to position around this breaking news. And so you can't have a deeply considered opinion on which you've reflected for some period of time and done a bunch of stress testing. That's just not the world of a commodity trader. You have to respond to markets in real time. And as a result of that, you get this really interesting psychological element to it that can cause all oil prices to rise in tandem. And where there's not this consideration of which should be rising more quickly or more aggressively than the other, everything's going to rise when we see a meaningful fraction of global oil supply come offline. And then over time, you get to a sense of whether some of these crudes really should be more expensive than others based on logistics and demand patterns and geographical distribution of supply and demand, all that stuff. You can consider that over time as you get more information, as you watch the geopolitical actors respond to changes in the theater of combat. Then your trading strategy can reflect more of the reality on the ground as this reality becomes better known to everyone. So I wrote the post because there's sort of a rational, data-driven component to what's happening there. There's also a psychological component to what's happening there. These things work on different timescales, and all of that is very interesting to me. But also the fact that war is so unpredictable and so dynamic, and the end game is nearly completely uncertain, that we are going to see this kind of tension, this kind of uncertainty, this kind of competition and discovery in commodity trading markets. We're going to see this unfold countless times as the war evolves. So I hesitated almost to write the post, only in the sense that any observation really that we make as the war is ongoing risks becoming stale in a matter of minutes or hours or certainly days. But I decided to write the post because there is a structural element to the spread between these two primary oil benchmarks that is worth considering. And even though the dynamics do change day to day, and the war is going to have that reality, will turn that reality on its head from time to time, it is still worth our effort, I will argue, to pay attention to what the spread is and what it's doing, to try to hypothesize around it so that we can build a mental model of what is the state of global oil markets today and how might we expect that to unfold in the short term. And then the longer term, right? Are there things that are happening already in the context of war that we should expect to have longer term implications? And that will help inform any capital allocation planning effort that's happening internally. and where we may get pulled into that, or we may be leading that ourselves. And so it's worth, we don't want to immerse ourselves so deeply in the ongoing geopolitical noise and developments that we just drown in it, and we get distracted from the day-to-day of actually running the businesses that we're running. But I will argue this is not a time where we can just put the news down and say, hey, a week, 2 weeks, a month out, I'll just pick this all back up and see what has stuck. It's not totally unreasonable to believe that. And if you're really in the midst of incredible urgency in running your business, I totally get that. At the same time, if you are in a strategy role, this is one of those times where the developments are happening continuously in the short term, but following them is a useful exercise in hypothesizing around how, if and how you should evolve your enduring mental models about how these markets work. In a lot of cases, you're not going to update these mental models, but just the exercise of testing we had some considerable development in oil markets that caused prices to do something very different than maybe we would have expected or what they had recently been doing. And now we get to explore that and hypothesize around it and experiment and test and ask ourselves questions, ask questions of others that we trust. And so I wrote that post with that idea in mind, that no one conclusion or observation that we're going to pull from any day-to-day movement within commodity markets may on its own in a vacuum be enduring. But this exercise of helping us pressure test our mental models is very useful. That's why I wrote that particular post. Another post that I wrote this week was about how the war in Iran is maybe increasing the chances that the Alaska LNG project comes to fruition, and that there's enough off-takers for that project to ultimately get to FID and commercialize it. It's a project that's been around in some form or fashion for nearly 20 years and has not crossed the finish line. But this near-term war-driven disruption may be enough to push it past the finish line, as we saw through some of the reporting this week. And I wrote that post for the nature, exploring the Alaska LNG project specifically, but it's just one more example of this reconfiguration that's happening in the LNG space broadly. We saw the meaningful fraction of Qatar's LNG capacity has been taken offline and looks like it will take years to bring back online. So LNG is changing rapidly, and it is changing in an enduring way. And I wrote previously in weeks past about how stock prices for U.S. LNG producers are getting pushed up because the world has this thirst for LNG. There's a lot of reason for countries around the world to adopt natural gas as an increasingly important part of their power mix. And this LNG, for them, where they don't have domestic gas resources, the LNG has to come from somewhere. And as a result of all this geopolitical uncertainty, U.S. LNG now has an advantage that it had to some extent before, but the strength of that advantage is growing over time. And this Alaska LNG project is one more example. There's also, I wrote about this one because there's some real political significance to it, that the Trump administration, through its trade negotiations, is pushing really hard to find ways to mitigate U.S. trade deficits, and other foreign countries buying U.S. LNG is an important tool that the Trump administration is using to try to combat these trade deficits. If more other countries buy more U.S. LNG, then the export side of our ledger goes up, and that's a metric that the Trump administration pays a lot of attention to. So when we get the disruption that we're seeing with the Iran war, specifically as it relates to LNG trade flows, that is something that has important implications on the U.S. LNG side. And because it has the political significance I decided to write that particular post. Another post that I wrote this week was about my talk to the Texas A&M Professional MBA program. I did that last weekend, and it was a talk that was scheduled. I was going to go down there for 2 hours to talk with the MBA cohort, and the talk was meant to be about how my journey through entrepreneurship, what I do, how I do it, some of the insights that I have shared on energy, and then talk through lessons learned, from coming from this corporate background that I've had into this entrepreneurial endeavor that I've been pursuing at KSG. So I went down there, prepared the talk around that, and started by sharing a bit about what I do at KSG, which of course is very heavily implicated in the world of energy. That conversation really took off, in part because of the Iran war and just all of the geopolitical developments that are happening that everyone is curious about. So we had a long conversation around that. My 2-hour window turned into a 3-hour window where we had a deep-rooted part of our talk that was focused on energy. But then I got into a bit about my journey at Criminal Strategy Group and how I use AI broadly across my business. Specifically, I talked about how I use AI to curate my energy information diet. One of the most important things I can do is make sure that I'm consuming the right information about what's happening in the world of energy. And as all of us know, and as I shared with the Texas A&M Professional MBA cohort, we are living in a world that is drowning in an abundance of information. I shared the quote from Herbert Simon, the Nobel Prize-winning academic, where he talked about what happens when you live in a world that has an abundance of information. There is a scarcity of what information consumes. So he asks rhetorically, what does information consume? And the answer is information consumes the attention of those who are directing their attention toward that information. So that's one of my favorite quotes of all time. I sort of butchered it as I hacked through it here, but I shared the quote in its written form to the MBA cohort, and I told them it's something I think about almost every single week, certainly every month. I think about that quote. And he gave that quote, I think it was in 1971. Is when he said that. So every generation of humanity, right, for as long as we've had an organized society, has felt like we are increasingly drowning in information. And we feel that now more than ever. And so one of the ways I use AI is to help me filter through all this information and find the highest value energy information that I can consume that will help make me smarter, that I am best positioned to offer insight around and to package in a way that is valuable to the people that rely on me to offer them insights into what's happening in energy markets and to help them develop their own acumen about how to read these markets and make the strategy relevant business decisions that help them most capably respond to what's happening in the world of energy. So the first step of me participating productively across the board there is by being incredibly intentional in how I consume energy information and also being intentional about what I do with the information that I consume. And AI figures very prominently in how I organize that part of what I do at KSG. And then in addition to the energy talk and the mechanics of how I've built and run KSG, one of the ladies there in the talk asked, I really liked the way she asked it. She said something like, look, not all of us are in the world of energy. And she had gone through my LinkedIn profile. And she said, I saw that you share career advice that extends more broadly than just people that are building their careers in energy. And she asked if I would say more about a lot of that. And I did. And one of the bits that I talked through there was the importance of other people knowing that you know what you know. For all of us, me included, right? It is easy when we think about how do we want to improve our professional prospects. The easiest path is I should know more, right? If I develop more skills, I can create more value. I will be more useful. The surface area across which I can contribute grows, and that's helpful. And none of that's wrong. My argument was the scarcer outcome, the harder one to build, is having more people know that you know what you know. That we should question ourselves when we think the default mode of improving our prospects is that we should simply know more. We should accumulate more skills, accumulate more knowledge. There's an excellent chance that you already know what you need to know to make a profound contribution in a number of different ways. And the challenge then is getting other people to know that you know what you know. Because once other people know that, you then unlock opportunity that otherwise would not have been available to you. So I talked with the MBA cohort about that angle as well. And it was a lot of fun, very rewarding, very exciting. I love the public speaking that I do. I'm doing it with increasing frequency, which is a ton of fun. But that talk was very different than the talks that I otherwise give. And I just really appreciated being involved there. So that's it for this week. If you want to see the full analysis behind anything that I talked about today, you can find me on LinkedIn. You can find the blog posts at criminalsg.com and check it all there. Thanks a bunch, and I'll see you next week.